We might just wait 20 seconds just for everyone to come into the room. Okay. Good afternoon, advisors and guests, and welcome to our advisor webinar. It's fantastic that you could take some time out of your day to join us. I'm Stephen O'Donoghue, Brighter Super's Head of Advice, and I'll be your host for this presentation. We'll run for about 45 minutes and then we'll open up for some questions. First up, I'm going to provide you with some quick information and introduction to Brighter Super for those that are new to working with us, and highlight some of the changes we're implementing to make the fund stronger and more rewarding for members. We'll then hear from Mark Ryder, who is Brighter Super's Chief Investment Officer, who will take you through our rationale for the investment changes and how they can benefit you and your clients. For the last part of today's presentation, I'll jump back in and I'll take you through a bit of the work we're doing to support our registered advisors, followed by question time. So please send through your questions in the Q&A function, and we'll aim to get to as many of those as possible by the end of today's session. Before I start today's briefing, I'd like to acknowledge the traditional owners of the lands on which we are meeting and pay our respects to their elders, past, present, and emerging. We recognise and celebrate the continuation of a living culture that has a unique role in this region. I'd also like to let you know that today's presentation contains general advice. It has been prepared without taking into account individual circumstances, objectives, or financial needs. We will also be talking about the fund's performance, and it's important to know, as we all know, that past performance is not an indication of future performance. So don't rely on this information alone to make any guidance or advice or decisions regarding superannuation. For those that don't know me, I'm the Head of Advice for Brighter Super, and I'm responsible for the internal and external personal advice offering of the fund. And I've been in the industry for about 20 years, and I'm passionate about our advice and how to get more Australians to receive advice. It's hard to believe that we're already well into 2024, but time flies when you're busy, and we've certainly been very busy at Brighter Super. As you may know, following our journey we've been on merging 3 funds into one, we are now a well-sized fund managing around 31 billion and 230,000 members. We are a proud Queensland-based fund, and in fact, we are the 4th largest non-government financial institution in Queensland, serving Australians everywhere. A good thing about mergers is they create an opportunity to select the best practices, tools, and systems from foundational funds and apply them to the entire business. So with this in mind, I'd like to share our latest change, further realising the benefits of our mergers. And excitingly, these are all 18 months ahead of the plan. From the 31st of May, we are improving our fee arrangements and delivering streamlined investment options in line with our commitment to improve our service offer and reduce costs. We'll communicate these to members via a significant event notice this week, with members starting to receive emails or posts from this afternoon. So this webinar is a good opportunity for you to hear about these changes firsthand and to be prepared for client questions or meetings. The key changes you need to know about. We are streamlining our investment options into one investment menu for all members. This is following a rigorous review based on performance, fee structure, and management. We are reducing from over 30 options to 12. Importantly, 5 of our existing optimizer multi-manager investment options are being retained and will be renamed to the shorter and simpler name of the 5 Brighter Super options that we are closing. As a result, the impressive performance track record for many of our heritage optimizer multi-manager options will continue. Several investment options will be closing, with members invested in these options to be automatically switched to comparable continuing investment options on the 31st of May. Our two socially responsible options are included in the options that are closing based on a number of factors, including costs, performance and risk, socially responsible investing capabilities, and the declining number of members investing in these two options. So ultimately, it was not in the members' best interest to continue to offer these options for members. By consolidating investment options, we are also giving all members access to unlisted assets held by the fund and a range of multi-manager strategies. And Mark will talk to this shortly. In terms of our fees, from the 31st of May, members will benefit from fee reductions across most of our investment options. And I'll take you through these in a moment. And we are retiring the Optimizer product name and moving forward with the Brighter Super Accumulation and Brighter Super Pension name. Since our merger, we have operated two separate sets of investment options, one for Brighter Super members and one for members with Suncorp superannuation called Brighter Super Optimizer. Our intent has always been to align our investment options for all members in order to simplify our product offering and to save costs. So from the 31st of May, you'll see these plans come to fruition with the creation of a single comprehensive set of investment choices for all members. For most Brighter Super Optimizer accounts, we're changing the percentage-based administration fee for all options to 0.18%. And this will result in an admin fee reduction of up to 70% for some members, which is a great result. Optimizer accounts will also benefit from a significant reduction to the administration fee cap. This cap is also reducing by up to 70% from $2,950 to $900 per financial year for all investment options. This change is effective from the 31st of May, with a pro-rated adjustment for the remainder of this financial year, with the full fee cap taking effect from the 1st of July. We are also bringing more transparency with a move to direct admin fees across the board. So administration fees and tax rebates will be listed separately, and you'll be able to see those on Member Online and in our annual statements. Importantly, though, members do not need to take any action with what we're doing. If they're invested in one of the closing options, they will automatically be switched to the new investment option effective the 31st of May. And of course, if members would like to review or change the investment options, they can do so at any time by logging into their Member Online portal. So that's all from me at the moment. I'd like to thank you for your interest in our fund, and I'll now hand over to Mark Ryder, who will provide more detail on the investment changes. Take it away, Mark.
Thanks, Stephen, and welcome everyone to the webinar. Look, I'm excited today to take you through about Brighter Super's investments and the changes that we're making. First of all, probably a bit of intro for me, for those who don't know me. I've been the Chief Investment Officer for a bit over 2 years now at Brighter Super. I've got, it says over 30, but I think it's getting closer to 40 years of financial market experience. Originally I started at the Reserve Bank and moved to various roles in financial services, chief economist for UBS Investment Bank, before chief investment officer roles at ANZ, as well as Christian Super before here. So I've had a wide variety of experience, and I bring that to managing the investment team here at Brighter Super and managing the investments that we've got. As you can see there, I'm sort of also active. I love the water, love scuba diving, and unfortunately at the moment I'm a Rabbitohs supporter. But things will be on the up and up eventually there, I'm sure. Look, going to the next slide. Yeah, this just covers the agenda. I'm going to go, it'll go through reasonably quickly. There's quite a few things I want to talk about. First of all, who's Brighter Super, and then go through about our philosophy, how we build portfolios, about responsible investing, about the part Queensland assets investments actually play in our strategy, before getting into looking at what actually has changed in the funds, and then finishing up just on where we are on the Lonsec rating process. If we look at the three organisations which have made Brighter Super. They've both got sort of long histories. If we think of LGIA Super, the history there dates back to 1965. Energy Super is the youngster on it, dating back to 1976. And if we think of the Suncorp heritage, that really goes back to the early days of the 20th century. So we're talking about organisations which have got long and successful histories. The merger process which we've been through initially was Energy and LGIA, which basically that the new entity started on the 1st of July 2021 with the SFT of the funds and when they merged together. The next major step came in sort of 1st of April 2022, when we saw LGIA Super, as you know, at that stage, acquired the Suncorp's superannuation wealth business. The name changed on the 1st of July 2022 to LGIA Super, and then of course we had the SFT, the merging of the two funds into what is now Brighter Super. And really what today's about is that next step, which is at the end of May, when we streamline the investment menu and really bring to a close the integration of the three funds into one complete fund. In my next slide, I'm just going to cover off on about investment capabilities. I think when looking at what we've done, we've really, I think, brought together these three funds. It's really much an amalgam of the best aspects of the three predecessor funds. We've got an investment team of 12, which has been enlarged significantly since I joined and strengthened. We've undertaken, as we've brought the funds together, strengthening the investment governance framework, which has been reviewed and uplifted, and it's a real area of focus by APRA and an important one that all funds, including us, meet. In the building of the new fund, what we've also done is we've got independent investment operations and investment risk teams, and what they do, they're established to provide, independent of the investment team itself, oversight of performance, valuation, risk management of the portfolios and portfolio monitoring. Very important separation of duties which we have there. We've also invested greatly in data capabilities. Bringing three funds together, there's a lot of data, there's a lot of history there, and we need to actually have better understanding of what's going on. And so what we've done is we've invested a lot of money to set up an investment data warehouse. We've introduced risk systems such as FactSet, which we also use for our analytics in terms of performance. So building up that capability that we have on the IT side. And finally, I think probably the important thing is that it was quite opportune time when we brought the funds together, because the portfolio construction, which I'll talk about in a minute, really has been one where we've been able to adapt the portfolios that we've had for the changing economic and market environment which is out there at the moment. And that very much, I go back and when I first looked at the Suncorp portfolios when they came across, was really much a key element of the portfolio construction in some of the asset classes where it did evolve with the way the markets were going. And I think one of the other things is that in my next slide is about, if we look at the performance since the 1st July 2021, when the merger happened, what we'll find, if we take the Brighter Super Balance option as an example, and we've got the multi-manager growth fund, the previous Suncorp fund, you can see that they're basically returned the same over that period of time. The path to that has been a bit different. The Suncorp optimizer multi-manager funds have been somewhat more volatile, which reflects, as I'll touch on a bit later, that there is a degree of illiquidity and somewhat different portfolio construction in the Brighter Super Fund. But interestingly, over this period, what we find is that the underlying performance has actually been solid and has been, for both funds, above the median in the market. In terms of our investment philosophy, there are really 6 parts that we look at. In what we say, and probably it's not uncommon, that we're long-term investors. Superannuation is a long-term investment journey people are on. And what we're really looking to do is build portfolios, not to just to do well this month or next month, but to do over the long run. We do look to exploit opportunities in the short run, which may present themselves, provide long run value. But basically our eye is very much on that long run. In terms of the asset allocation, we believe that this really is the key thing which underpins the return of the fund. What we're looking to access in the investments we've got, the asset classes, is really the beta of the underlying investment. We do look to do it in a mixture of public and private assets as well, and are happy to have a degree of illiquidity in the fund as well at a prudent level. Building on that one really then comes down about diversification. What we're looking to do is really to try and build a portfolio which is well and truly diversified, and not just in name, but in practice. And I think that, as I'll mention a bit later, does come back as well when thinking about the element of some of the liquid assets we have there, that they really bring true diversification to the portfolio. They've got very distinct parts that we're looking for them to play. The fourth one is about active management. We're a believer in active management, but when we say it should be efficient, what we're talking about there is we're looking for active management that will, we've got a fee budget for our portfolio, and we want to put it in the most positive area for the portfolio. There are some areas of the market where maybe better off having just index portfolios, or not having it completely active. So we're going to make that decision, because what we really are focused on number 5 is about cost matters. In the end, what probably the real key thing is about that net return, but we're very judicious about trying to choose about where we use the fee budget that we have in terms of that mix of assets we have in the construction between active or passive or public markets or private markets. And finally, and I will talk a little bit later about this as well, we're committed to responsible and sustainable approach. Now, we are building up our capabilities in this area, and are looking to probably do it in a way where we summarize it as it's about value and not values. ESG and responsible investing actually helps control risks. We're not doing it for an ethical reason. What we're doing it for is because it's in members' best financial interest. Now, when we look at what do those principles actually mean, the way I think about it is it comes down, we've got very much an issue here of constrained optimization. By that I mean we want to achieve strong performance, and performance can be, when we look at the 3 performance objectives we have, there's the real return, the CPI plus objective. There's how we do versus peers, but there's also the your future, your super, which is your license to actually operate in the superannuation market. We're trying to maximize that, but it's also subject to a number of constraints that we have. And what really that comes down to is that we do have a illiquidity budget, that there's a limited amount of illiquidity that we're looking to take. And currently the illiquidity in the fund is 22%, which is actually below sort of the maximum level. So we're quite comfortable with that level. But we also need to manage the fund and our options relative to a risk budget, about how volatile they are. And that can be reflected in their standard risk measure. We want a spread of those across the menu that we have, as well as the tracking error to its benchmark, and the Your Future, Your Super is probably the best one to think about there. We also have a fee budget. I mentioned that earlier, that we focus. We're very conscious about the cost of our investments and want to get value for money and make every dollar count. And that's another constraint that we build the portfolio to. And finally, there is around sustainability and around about our ability to make a more sustainable portfolio, one which controls for the risks out there, but one which we can build into a portfolio where we're attempting to drive the best performance we can, and ultimately build this portfolio in the best interests of members. Looking at how this all then translates in the portfolio construction, what I've got here is 6 sort of principles there. The first thing is that the portfolios we tend to build in the diversified portfolios, we are running a relatively constrained tracking area. We're not looking to run very volatile portfolios, but we are looking for ones which actually derive good long-run returns. In listed assets, what we're looking at is a broadly style or factor-neutral type of exposure. We're not building portfolios which are either tilted significantly towards growth or value. We're building portfolios which actually have a more of a neutral style. In terms of unlisted assets, we see that it really provides a great opportunity for diversification, but also return. And the return outlook for a number of the assets we invest in is quite significantly higher than what we can tap in public markets. And it's when we come down to it, it's also going to be one of the highest sources of tracking error in the portfolio, along with the potential for alpha being generated, which will ultimately come together as key drivers of return for the fund. And when talking about returns, the SAA, so the asset class construction, whether we have equities, whether we have bonds, whether we have cash or infrastructure or property, they're ultimately the key drivers. The dominant driver is the beta which we derive from the asset class. And there will be a mixture of assets, as I mentioned, which some may be passive, but there'll be other ones where there'll be a degree of active management where we're looking to derive alpha as well. Our ESG policy is one where it's not built around just the straight exclusion in stocks. What we're looking to do in ESG, as I'll talk about a little bit more in a minute, what it is about controlling for risks. It's about our fund managers that we use, integrating that into their processes and the way that they actually manage the portfolio, so that they're taking that on board and what we're looking to achieve. And then finally, we're building all of this subject to our targets on fees. We're looking to have for the My Super Fund, for example, for that to be running at a level below the median fee in the market there, whereas for the other options, we're looking to actually have that around that median fee. So that constrained optimization process I spoke about, maximizing our return subject to these constraints, the way that it builds out, and you'll see a little bit more of that in a minute as I run through where the portfolio is positioned, is sort of really summarized by these beliefs. In terms of thinking about how do we build the portfolio now, I think and I mentioned this as well a bit earlier, that it's really about the market and the economy has changed in recent years. And it's really about we're looking to evolve the portfolio to meet that. And some of the things which are front of mind for us when building the portfolio, which is summarized by quite a bit of text, but the key things I've summarized and left there. One is that we believe that we're getting an increase in volatility of real economic activity. Part of that can be because of some of the supply chain disruptions where we're seeing. Some of it can be due to geopolitical. Some of it can be underlying volatilities driven by the big swings we've seen in monetary and fiscal policy. One of the other ones, and probably a key risk we're focused on, is around higher and volatile inflation. And while we don't expect to see inflation going back to the peak where it was, we think that there's probably going to be a bit of a struggle to get it necessarily back to exactly where central banks want to see it anytime soon. But we think that can be an ongoing issue as well in the world we're in at the moment. Interest rates, the reset, if I go back 4 or 5 years ago, we had close to zero rates. Things have changed there now. Government bonds, for example, can provide reasonable returns as well as downside protection. We're taking that into account in the portfolio. And it's not just about sort of the asset classes. Within those asset classes, there are issues there around, for example, energy transition and digitization. The idea of how do I exploit these? How do I get exposure to these growth areas, which we expect to provide good returns, but also actually help build out that critical infrastructure that we're looking, whether it's to do with energy transition or whether it's to do as we try to cope with the changes in technology which are coming through. So all of these changes, particularly the some of the sectoral opportunities which come, which is where sort of some of the unlisted assets come in. You get more targeted there. But the other things about volatility, about inflation, and about interest rates are all real key elements which have gone into the construction of the portfolio. So on the next slide, I just sort of summarize what I mentioned earlier, that what we've really got is an amalgam. We have an amalgam of the three funds come together, and we had the opportunity to actually choose the best bits from across the three funds. So, for example, take Energy Super. It contributed sort of the private equity assets and strategy, along with the bulk of the active Australian and global equities portfolio. LGIA Super contributed the private credit and unlisted infrastructure portfolio. If we look at the optimizer, so the ex-Suncorp SPSL, number contribution there, it's contributed active equity managers, some outstanding managers there, Alfinity and Royal London, and Royal London certainly has been a very important addition to the portfolio and has performed very strongly. One of the things which we learned from them as well was around the dynamic allocation process, particularly international equities, about the evolving nature of the type of managers that you have. And that was something which really did play out. And Royal London was a key part of that. And we were very happy to take that on board. And there's also the DAA process, so that dynamic asset allocation process, which Suncorp had been implementing through with Morningstar's assistance. When we look at on the asset consultant side, we've got Jana was the LGI Energy Super consultant, Morningstar with SPSL. We're looking to have both of those engaged, and on the Morningstar side is particularly just around that DAA part, with Jana being the more overall. So once again, bringing together probably the best parts of what we believe was there. So when we combine the funds, which you'll see in a minute, what it really is, that some of the changes which have happened have been around consistency of currency hedging. The optimizer options really had no hedging on the international equities. And particularly, and it served the fund very well as we moved through over the last few years. But given the Aussie dollar down around the 64, 65 cents level, we think it made sense that we actually introduced a limited but a degree of hedging in the portfolio and when we've brought them together. So that's one of the changes that an optimizer member would find. In terms of the liquid asset classes, this, as I mentioned earlier, one of the changes. We're probably targeting about 25, but we're currently got 22%. The difference being just the opportunities we're looking to invest in over the next few years. And then finally, what we are doing as well, we're allow as the market evolves, our approach on what is the optimal SAA will evolve, and which is something I will turn to now in the next slide, which is around particularly thinking about unlisted assets. And for us in unlisted assets, there's a number of things you want them in there for. It's very much about diversification opportunities, that the unlisted assets can provide unique investment opportunities that aren't readily available in listed markets. And the things you can particularly target the portfolio construction approach. As I mentioned, if we're considering we want to play a part in, we believe it's whether it's in digitization, could be data centers, whether it's actually going into areas of the energy transition, the unlisted assets be able to give you ability to get a more focused target. But what they can also do, and one of the things we aim, and particularly given our concerns about inflation risk, that these real assets are expected to, and they have, if we look over the last couple of years, provided an effective hedge against inflation due to that ability that they can link revenue to inflation, as well as to economic growth. And the chart on the bottom right, you can see there is a chart from Macquarie Asset Management, and basically just shows on the far right, you can see that the dark blue bar is the unlisted infrastructure. The lighter one is equities, and then the red one is global bonds. What it actually shows in that environment when inflation is above average, and when growth might be up or might be down, what it actually shows is that the best driver, best performer over that whole period tends to be infrastructure. It's got those abilities to deal with both weaker growth, which equities like, but it also performs better inflation. So in these volatile, uncertain times, we think that's important. The unlisted assets do provide also a decrease in volatility, and it's not just because that they only get valued every month or every quarter. It's actually due to that characteristics and some of those ability to choose assets which have these desired characteristics. And finally, there's the higher return. When we look at private equity investments, or when we look at some of the infrastructure projects we've got, we're targeting to get something which is approaching around 15%, which is well in excess of what you'd expect from listed markets. The chart on the top right of here actually shows you sort of rolling returns there of unlisted infrastructure versus global equities, and you can see there that there are strong returns which can come through, for example, from going to that asset class. But it also reflects that there's a illiquidity premium, which are getting these assets for just locking your money up for a certain period of time. On the unlisted assets, one of the things we are very much rigorous on and aware of is around the valuation of those. I mentioned earlier about there being an independent investment operations team, and what they're doing is, where the investment team is not responsible for valuation policy and the value of assets. That's something which the investment operations team is. The majority of these assets are valued monthly or quarterly. Out of cycle valuations are possible as well, and this is all overseen by the executive investment committee, which is the valuation committee. One of the key things involved in when we choose a manager and choose whether it's the listed or an unlisted, probably more important unlisted, is around the quality and the strength in terms of their valuation policy, so that we know that they're getting the appropriate independent valuations coming through, which they pass on to us. We don't value any of these assets ourselves. That's overseen, as I said, the managers value that, and they're independent. They come through to the investment operations team for valuation, and then of course there's cross-checking of these by our external auditor as well. So a big focus for us, but a necessary one. In terms of responsible investment, there are 4 pillars that we've actually got here. We have, as you can see here, the first one is it must be members' best financial interest. Everything we do when we manage these funds is for the betterment of the members. What we're looking for as well is we're looking that it has a negligible impact on the risk and return of the portfolio. We're not looking to give up. We're doing this, as I mentioned earlier, the way we summarize it, it's all about value and not values. We're not doing it because we don't like something in particular. We're doing it, we might be, our managers or may exclude something from the portfolio because it's actually, the risks are not priced correctly in the asset, and that's what we're looking to do. We're looking to control the risks which are there in the members' best financial interest. On the next one, it's genuine in both intent and outcome. That what we're doing is, we're doing this because it will make a difference, and we believe it will make a difference. And the final thing about divestment is sort of not the way that we're looking to do this. There's an active decisions. There's a very limited number of stocks which we won't invest in because of government regulations. But otherwise, what we look to do is to leave it to our managers, as well as to as a capability we're looking to develop, as well as actually to try to build up our stewardship capabilities as well, and which we've recently done by joining AXI, which provides those type of consulting services. Moving through to the next one, next slide as well, I think Queensland Investments has been an important aspect of the predecessor funds, Brighter Super. Energy and LGI in particular had assets which were spread across the state, and that continues to be the case. Currently, it's currently worth around $1 billion in terms of specific assets. And this slide here just gives you a bit of a guide to where those assets are and the spread that we've got. And it's an area where we're also continuing to do work on and looking to, as the time progresses, to continue to build out our portfolio, to invest in the communities where our members live. And we're looking for a win-win. It provides a necessary return. We're not going to give up any return, but it's something which can be something which our members can use or maybe enjoy. But that continues to be a key part of our strategy. You saw this slide early from Stephen about the streamlining of our investment options. And so when looking at it and going on this slide from left across to the right, what it is showing is the go-ahead options that we have. We've brought together the Brighter Super and the old Suncorp options into one consolidated streamlined menu with, as you can see there, basically four sort of conservative, four sort of more balanced options, and then finally the more higher growth options, a combination here of single sector as well as diversified. This next slide here actually is just a summary of what was available in the Sen in terms of there have been name changes for the Optimum multi-manager funds, and as Stephen talked about earlier, and you can see that there. But there have also been, given the single sector options have closed, some of the previous Suncorp ones, along with the external managers as well. This just illustrates the mapping which is playing out there as well. But this information has been made available. But that's how it looks in terms of the mapping from where they were to what they're actually invested in, or what the name is now. In terms of the construction of the portfolios, this slide here actually shows you the new diversified members from the optimiser's perspective, and it shows you how the SAAs have changed. And there have been changes in the My Super as well as in the options, but I might just, to illustrate the changes which have gone on, and I probably alluded to this a bit as well as we've gone through, which is, I'll look at the balance option. So what's changed here? Probably one of the key changes around equities, you can see in the balanced option that there's been a decrease of 5% in Australian shares, and we've got a decrease of a couple of percent in international shares. That's largely made up by an introduction of private equity into the balanced portfolio. At this stage, as I mentioned earlier, private equity returns are expected to be stronger over the medium term compared to equities, and we actually have seen listed shares have started to move up quite strongly over the last 6 to 8 months. So that move there is around building, once again, a more robust portfolio, and one where the private equity portfolios do differ somewhat to what you're actually getting from the share market as well. In terms of other unlisted assets, in property and infrastructure, there has been a shift there. In terms of the change in the change in listed property in aggregate, and what you can see here in Brighter Super, we've aggregated into property overall with listed and unlisted. In the optimizers, we've got it there as it was, which was showing as Aussie fixed income, Aussie listed property, or international listed property. When you add it all up, what you find is property is up just 0.5%, but there has been a switch from all listed property to predominantly unlisted. Infrastructure is an area which has picked up quite a bit. I mentioned earlier, one of our concerns and focus has been around the inflation risks and the protection it does provide. We're looking there that on infrastructure there has been a 5% increase. With, once again, that's predominantly going to come through an unlisted, where we get that more targeted behaviour. There's also other assets coming through here, diversifying strategies. The assets we have in there are sort of PE-like, but just a more moderate risk control level there. And on the fixed income, what we've got in aggregate is somewhat of a decrease overall in the fixed income exposure, but there has been a bit of a introduction of only around 3% in the balance fund of credit. So taking some a liquid credit, higher returning as well, providing another characteristic to the portfolio. And if we go through all that, look, the similar type of changes in conservative balance to stable as well. But in terms of the stable option, what you'll notice there is that we're taking opportunity as some of the higher interest rates outside of cash by bringing the cash allocation down and having a higher allocation to more the other asset classes, whether it be credit income or an Aussie or global fixed income. The next slide just makes the point as well on the single sector menu in terms of the allocation there. Probably key things to note here, and where there has been a bit of a change at the Brighter Super side, has been around the listed and unlisted. We have brought down in property, that is, we have brought down the unlisted component, and now from 85% down to 50%. So building more liquidity into that option as we have done at the fund overall. And the diversified fixed income portfolio, which we have there, is a 50-50 between Aussie and fixed, Aussie and international fixed income. In terms of the rating process, which is underway with Lonsec, we're in the process now of providing data to Lonsec. We've got the asset harmonisation or the option harmonisation streamlining occurring at the end of May. The fund will be reviewed in June 24 once we've finalised that process, and the report will be published in August 2024 by Lonsec, and the funds it will be covering the ones you can see here. We're getting 3 funds initially rated, and then of course there'll be ongoing review as well. So to finish off, over the last 3 years at Brighter Super, we've really tried to build portfolios by picking the best aspects of all the 3 predecessor funds. Along the way, we've strengthened our investment capabilities and the oversight and the governance of the fund as we've taken the funds on board. I think it's important that through the volatile times that we've been in the testing markets, I think fund performance has remained solid and above median for both the Brighter Super and the optimizer options over this period. So we've been able to make that change as well as keep performance going and really take those opportunities as markets have been evolving. And the journey we've been on over that period since beginning in the 1st of July 2021, really sort of that final step is the 31st of May, where we bring together and we've got one final integrated set of portfolios. That integration for the optimizer funds, when we took them over from Suncorp, the first step was at the end of September 2022. The next step was at the end of May last year, and when we had the SFT, and then final step will be as we integrate them at the end of May. And I think probably it's important to remember as well that through all this, I think as we've increased our scale and capability, all members from across all 3 of the predecessor funds are benefiting from the benefits, whether that can be in fees, whether we believe that's in performance as well, and we look for more to come. So with that, I'm going to bring my presentation to a close and hand it back to Stephen.
Thanks, Mark. So what I'd like to do is just fill you in a little bit on what we're doing to help make it easier for you to work with us and to manage your clients who are invested with us. So I'll start by giving you some context on how we've structured our advice services as a fund. So at Brighter Super, we do offer a complete advice solution internally for our members, and this ranges from general and intra-fund advice, which is available under a member's administration fee, to a retirement health check service at a flat fee. And we do offer a scaled and comprehensive advice service internally based on a fee for service. And we are committed to providing more advice to more members and to be known for the quality of our advice offering. We have 41 Brighter Super employees providing this range of advice services to our 230,000 members. And we know we can't do this on our own. So we respect that some members will seek external advice, and we want to work with you to be a fund of choice for our mutual customers. So we respect the advisor relationship by referring members externally if they are looking for an external advisor, and we triage members for advisors that are listed on their account to those advisors should they contact us for personal advice. And on that note, we now have over 1,300 external advisors registered with us and an online portal that allows these advisors to access information on clients' accounts and to be able to charge fees directly to their account. We also launched a member report function in the portal in January, allowing listed advisors and members to generate tailored member reports via their online account at any time. So this saves having to wait for an annual statement. On the investment side, you can access detailed portfolio holdings at any time on our website, and this is updated twice yearly. This will also give you an added level of oversight when compiling research for clients. We are also working on developing information sheets for our Brighter Super investment options, which will be released soon. You have heard from Mark that we are engaged with Longsec to rate Brighter Super, and this will also help with your decision to recommend Brighter Super in your advice documents. In December, we introduced a new advisor line to ensure financial advisors are serviced by specially trained consultants who will be able to address your needs in a timely and efficient manner. So when you call up, option 1 is what you pick to be directed to this dedicated team. Now, if you are a third-party advisor and not an advisor that's registered with us, the process is very simple, and our business development team will be able to walk you through this. Because as a listed advisor on Brighter Super member account, you have the option to charge advice fees, and we offer one-off, fixed-term, and ongoing fee options. And we are continuing to invest in further enhancements to make it easier for you to work with us. So soon, listed advisors will also be able to download client list extracts from Advisor Online, and we are developing online application forms for you to transfer from super to pension, as well as open up new accumulation accounts online. We're also keen to meet with you more often, so you have the information and access that you need to assist your Brighter Super clients. So put the 1st of July in your diary already, as we've locked in Astron to present the FY24 results for the Astron Capital Guaranteed Fund, and invitations will be sent closer to this date. So this year is all about focusing on consolidation and ensuring our members continue to benefit from the mergers, as you've heard, particularly those members who are close to retirement. We know the switch to retirement is such an important life stage for many members, and it's where they need our help the most. So with this in mind, we are creating a retirement income strategy that will act as a roadmap to help more members live a comfortable retirement. Our objective here is to design a fit-for-purpose product, education, guidance, and advice service tailored to the different needs of our members as they draw closer to retirement. So we will soon launch a couple of ways for members to manage their account-based pension. There'll be a ready-made 3-bucket strategy if a member isn't sure on the best way to invest their money so it lasts longer. We can take that off them and we will invest their investment choice for them. There will also be a flexible 3-bucket strategy which follows the same principle, but it lets the member or their advisor determine how the money is invested and how much is paid. We are also exploring a 4th bucket, which is a lifetime pension designed to work within or alongside a member's account-based pension. Also, leading the charge in education and servicing, our focus also includes a new arrangement with David Koch, which you might have heard, who is working with us to improve our member proposition around things like financial literacy, education, and advice. Our members have been very positive about this arrangement with David, and we're really looking forward to working with him to build member knowledge and confidence and encouraging members to get advice. Finally, as we've said, we have a highly experienced business development team who are here to help you and your clients to make the most of these changes. So please reach out to them with any questions or feedback, and we'll do our best to support you. With that, we've come to the end of the presentation, but we still have time for any questions that you may have that you want to put in the Q&A function, or if you'd like to come off mute and ask directly, please do that now, and I'll hand over to Dan and the team so then we can facilitate the Q&A.
Thanks, Stephen. So opening up the floor to any questions that people might have for Stephen, Mark, or others.
I think there was a question in the chat that just came through. Will we provide a copy of the recording? Yes, that will follow today and will be sent to everybody that has registered. And also those that hadn't registered, we'll be sending it to all advisors.
There was also a question in there earlier, where could advisors find more information for themselves and also for their members? There was an email we sent out on Monday night that had a link to the resources pages for the advisors. But on the website, under the resources section on the left-hand side, there's a significant event notice, and that has all the information, a copy of the sample sends that we have sent out to the members. And on the member portal, there'll be copies of the actual the correspondence to that particular member. So some really good, useful information. Reach out to us if you do have any other questions on that.
Sure. There might be another question in the chat. So there's a question around additional information to the 3-bucket. So we will have more information on that shortly and be looking forward to sharing that, but we don't have anything at this stage to confirm, but that's something that will be coming shortly.
I've got a question for Mark from Ryan. Why the move away from index investment options when it's an area that members have a distinct level of interest in?
Anyway, Mark, I'll let you handle that one.
Yeah. Okay. Look, I think the move away. I think it sort of came down to thinking about the construction of, do we provide just an index portfolio, or do we provide the portfolio that we've got there, which is actually a mixture of both. It's probably it's the type of strategy that we're building into our options, and so that's what we've decided we will bring. And as I mentioned, there's a whole move there about streamlining and bringing down the number of options we've got. And what we've chosen to do is provide, rather than index and an active, but provide our best option there, which is actually, in the end, it's a combination of having predominantly active, but also having an element of passive in there as well.
Thanks, Mark. I think Mick's asked a question around DocuSign forms. So yes, we are exploring digitization of our forms and processes. Absolutely. We are trialing that in the internal team at the moment to see how that plays out, but that is on our roadmap and our focus to make it easy for you to change and switch and withdraw through the digitization of processes. So that we don't have a plan yet, but we have a plan for a plan.
Anything else there in the chat so far? Last couple of minutes for anyone that's got any burning questions.
Well, if there are questions that you may have that you want to ask post this, please reach out to myself or any one of the team. Have a look at the send information. It obviously is complex and comprehensive. Hopefully today gave you a heads up on what is important to you, especially around unlisted assets, which is new to the portfolio. So please take the time to read through the sends. If you have any questions, reach out to the team. Otherwise, I really appreciate everyone dialing in today, and the recording will be sent out shortly following. So have a great day and thank you.